Global markets are mixed overnight, although tension is building around France's budget crisis. The Bank of Korea unexpectedly cuts rates amid rising downside risks. Australian capital expenditure resumes growth in the third quarter, and New Zealand business confidence continues to firm. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ FX analyst Kausani Basak reviews how Vietnam's economy has rebounded from Typhoon Yagi and how its export sector could be affected by US tariffs.
Our 2025 growth forecast faces several challenges due to the recent US election outcome. US trade and foreign policy will be pivotal for Vietnam's growth outlook for next year.
But first, in 5 and 5 with ANZ, global markets were mixed overnight. US stocks were down around 0.3% by 4 a.m. Sydney-Melbourne time, while US Treasury yields were flat to up around a basis point or two. The US dollar index was up 0.2%. The main action, though, was in France, where there are fears a budget crisis could bring down the government. The premium for French bonds above German bonds, and that's a premium not in a good way, rose to 90 basis points overnight. That's its worst level since the 2012 Euro crisis. The French 10-year yield, for example, rose to 3.02%. That was above Greece's 10-year yield at 3.01% for the first time. Meanwhile, the Bank of Korea delivered a surprise back-to-back 25 basis point rate cut yesterday, citing growing downside risks, including from US tariff policy and exchange rate volatility. Here's ANZ economist Crystal Tan.
The central bank now anticipates below potential growth in the next couple of years, citing a weakening outlook for exports amid intensified competition and a potential rise in trade protectionism following the US election.
As of 4 a.m, the Aussie dollar was flat at 65.01 US cents, and the Kiwi dollar was also flat at 58.89 US cents. Number 2, Australian private capital expenditure rose 1.1% in the September quarter, having fell in the second quarter. ANZ senior economist Adelaide Timbrell says, though, there has been a softening of 2024-25 investment plans. They were 12.5% ahead of last year at the beginning of the year, to being now just 4.3% ahead. That's because cost rises have slowed and underlying economic momentum has softened. Here's Adelaide.
In terms of Australian GDP forecast, the lower than expected machinery and equipment capital expenditure did put a slight drag on GDP, but our forecast remains at 0.5% for the quarter. We saw a 1.1% rise in both building and structures and machinery equipment capex, bringing total capex up 1.1 for the quarter.
Number 3, it's onwards and upwards for activity recorded in New Zealand by ANZ's Business Outlook survey. While headline activity eased 1 point to 65, ANZ New Zealand chief economist Sharon Zollner says that's still high. Expected own activity rose also 2 points to 48, while inflation expectations fell. Here's Sharon.
That's good news for the Reserve Bank that inflation expectations dropped from 2.8 to 2.5%. That's a particularly large move over just 1 month. And that's probably because the CPI for the September quarter came out at just 2.2%, and that seems to have impacted things quite significantly there. The Reserve Bank will be pleased to see that. It brings this survey more into line with their own business survey, which is showing that inflation expectations are locked in at 2. We're not quite there, but getting there.
Number 4. Sharon says the sectors in New Zealand that were most negatively affected by high interest rates are now showing the greatest signs of relief.
That doesn't mean that they're strong, but certainly the V that we've seen in construction, for example, and their experienced activity has been quite spectacular, but they are still pretty much sharing last place with the retail sector. The Reserve Bank in their monetary policy statement devoted quite a lot of words to analysing which sectors of the economy are most subject to monetary policy, most sensitive to interest rates, and described some themes that have come through very strongly in our own survey. Agriculture, for example, their production levels are much more to do with the weather than anything else, and actually they are by far the most positive in terms of their past activity, as well as an improvement in the weather.
Number 5. Also in New Zealand yesterday, the monthly employment indicator showed the number of filled jobs down 0.1% in October, the 7th monthly decline in a row. ANZ senior economist Miles Workman says the numbers were in line with expectations for the labour market to keep weakening into the first part of next year.
We've penciled in a 0.2% quarter-on-quarter contraction in Q2 overall for the HLFS measure of employment, and the RBNZ is just a little bit more pessimistic than us on that measure at negative 0.3% quarter on quarter. Just looking at the trend here, it is certainly consistent with our and the Reserve Bank's view that the labour market is certainly lagging the broader economic cycle and that the trajectory is still southbound, and that's consistent with our expectation that the unemployment rate does have further to rise from here.
Miles Workman there. Now for our deep dive interview, ANZ FX analyst Kausani Basak reviews Vietnam's recent economic performance as it recovers from Typhoon Yagi and looks ahead to how pending US tariffs might affect growth in 2025.
In September, we saw that the impact of Typhoon Yagi was quite severe on the economy. Manufacturing activity contracted and export growth slowed down to low single digit. However, the impact was short-lived as October data showed a strong rebound in the economy. Among the subcomponents, both new orders and new export orders index reverted to the expansionary territory, reflecting improvement in domestic and external demand. Strong manufacturing performance supported exports, which grew by 10% year-on-year in October and generated trade surplus of $2 billion.
And just looking at the GDP heat map that you've put out on Vietnam, what sectors are currently leading the growth outlook there?
The manufacturing sector has been the main driver of Vietnam for quite some time now. In the first 3 quarters of this year, the manufacturing sector has grown by 9.7%, and in the third quarter, it accelerated to more than 11%, which pulled the overall industrial growth higher. However, most of this growth comes from exports of manufacturing sector. As a result, the Vietnamese economy is highly dependent on external demand.
And you've identified some weak spots in your note, in particular housing affordability. So what's happening in terms of affordable housing, and why is that a concern for your economic outlook?
We currently see 2 major weak spots in the economy. First is the real sector, which is recovering slowly, mostly due to an uneven recovery. The supply of affordable housing units has been scarce due to absence of new residential construction projects. According to Vietnam Association of Realtors, most of the apartments for sale are valued higher than VND 50 million per square meter. This has raised concerns over housing affordability in the country. As per data from Ministry of Construction, speculation has been a leading reason for the ongoing rise in prices. But commercial real estate has been faring much better. This is because they have received a strong FDI inflow. Between January and October 2024, the total real estate FDI inflow reached $5.2 billion. Now, the second weak spot in the economy is private consumption, which has been growing very slowly of late.
And then obviously everyone's looking at the impacts of the US election and the policies of the incoming president. So are there any concerns for Vietnam's economy following the US election?
Yeah, so with former President Donald Trump winning the presidential election, the USD has strengthened further on concerns that increased US tariffs will cause higher inflation in the US, forcing the Federal Reserve to halt their easing cycle earlier than previously expected. So this could mean a prolonged pressure on the dong. If the State Bank of Vietnam allows the dong to depreciate past the current level, we could see the risks of inflation increasing. Inflation in Vietnam already increased to 2.9% in October due to higher food and transport prices. This comes amid cautious spending by consumers over the past few months. So overall, higher cost pressure and amid cautious spending will likely weaken consumer demand further.
And what is the outlook then as we sort of end Q4 and head into 2025? What's that short-term outlook?
So for the last quarter of 2024 has started off on a positive note, and we expect this momentum will persist till the end of the year. As a result, we see significant upside risk to our 2024 full year GDP growth forecast. However, the pockets of weakness that are existing in the economy that needs to be managed through targeted policies to achieve broad-based economic growth. Now, our 2025 growth forecast faces several challenges due to the recent US election outcome.
Kausani Basak there. I'm Bernard Hickey. That was 5 and 5 with ANZ. For Friday, November the 29th. Catch you next week with a look at how Australia's economy performed over the September quarter. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.